Well, U.S. markets, all three major indices in the green right now to kick off a new trading month. Stocks coming off of the best February in nearly a decade, with both the S&P and NASDAQ hitting record highs this week. To break down areas investors may be overlooking, we've got Wei Li, BlackRock Global Chief Investment Strategist here. Wei, it's good to talk to you today. Looking at where things have tracked this week, we got a lot of economic data that essentially points to inflation still being a little sticky, especially on the services side, but some resilience in the economy. How is that, or has that changed your view in terms of the outlook at all?
What is really interesting, good morning, Akiko, is that so far this year, markets have significantly repriced on the rates side. So beginning of the year, markets were looking at 6 cuts and now just 3 cuts because of the inflationary pressure. So, for example, in January's CPI print, as well as PPI print, also the PCE print yesterday, supporting that as well, showing some stickiness. But despite the fact that markets have repriced on the rate front towards the hawkish direction, risk assets sentiment has been positive. Risk assets have delivered strong return because earnings are very strong. So on the one hand, we have rates. On the other hand, we have earnings. And when it comes to valuing risk assets, it's essentially discounting future cash flow, rates being the discount rate and future cash flow being earnings. So earnings, Q4 earnings are coming in more than twice as strong versus expectation at the beginning of the reporting season, driven mostly by the Magnificent Seven, which is why we continue to have a concentrated market rally, and we stay within BlackRock. We stay overweight U.S. equities with a preference for the tech sector for this reason.
Yeah, Wei, let's hone in on that and take the AI trade aside. You are neutral when it comes to U.S. stocks minus the Mag 7 there. What is it that you see right now that puts you in that position?
Well, we're neutral, the broad equity market minus the AI theme, because if we look at valuations in the US, valuations, the S&P 493, they are still at a level that is above pre-pandemic levels. So in terms of forward PE, it is above pre-pandemic levels. And this is in the context of rates having risen significantly. So typically, when rates go higher, multiples needs to come down. And yet multiples have expanded for the S&P 493. So that doesn't quite add up unless we see meaningful economy-wide productivity gain, which can be boosted by AI, but we're still in early days. So because of considerations around valuation, but also cognizant of what AI can do for the broader economy, when we balance out the 2 factors, which is why we are neutral on the broader kind of X-tech part of the U.S. equity market. But when we add the strong conviction of AI theme, including tech, including communication services into the U.S. equity mix, we then have an overall overweight for U.S. equities.
Wei, I want to get back to your what you talked about in shifting expectations for Fed rate cuts. You say that you see inflation staying closer to 3%, at least in the strategic horizon here. Is that where investors need to shift their expectation? I mean, you could argue that the shift is already happening, but what would be the case for additional or a rate cut or 2 rate cuts, 3 rate cuts here, given where the economy has been able to track even with inflation above that Fed's target?
Well, there are actually a few nuances in terms of our inflation view. So currently, as you said, Akiko, markets are seemingly expecting more sticky inflation, i.e. the last mile of inflation getting down to target being hard to achieve. We actually don't think that the last mile is that difficult to achieve because of very powerful deflationary forces coming from goods deflation as pandemic mismatch continue to unwind. So in the very near term, so the coming month or so, we actually see inflation falling faster the markets seem to appreciate, and that actually supports our current kind of more positive tone around US equity market. But over the long term, we see markets under appreciating the level at which inflation will settle. So if you look at US 2-year break even, it's pointing to 2.8% or so. We see inflation settling around 3%. So there's a bit of a nuance in terms of our inflation view. So in the near term, markets are not appreciating how quickly inflation can fall because of goods deflation. But over the long term, markets are not appreciating how sticky inflation can actually stabilize around a higher level. And for that reason, we're more positive in the near term for US equity market versus the strategic horizon US equity market view, where we are neutral because of concerns around valuation, and also the fact that we're then living with higher rates and also higher inflation.
Way outside of the U.S., you're quite bullish on Japanese equities. We, of course, have seen corporate reforms as a big catalyst, pushing the Nikkei to new records here. I wonder how much of that momentum you think can continue when you consider the pullback that we have seen in the Japanese economy, and given those comments we got from the Bank of Japan's governor, who essentially seemed to kind of pour cold water on any expectation of a hike, given where inflation is right now in Japan.
Well, if we look at Japanese equity market return, for example, last year, in dollar terms, it's not as good as it was in local currency terms, because a lot of the equity performance has been boosted by a weaker yen, currently trending around 150 versus the dollar. So the first leg of the good performance from Japanese equity market has been very much boosted by the monetary policy divergence theme, with Bank of Japan staying very supportive, but the rest of developed market central banks hiking rates aggressively. And the first leg of the return in Japanese equity market were also boosted by the exit from decade-long deflationary mindset. But in terms of the corporate reform, which is hard to come by, which takes time to come through, we believe that there is more room for reform to actually benefit corporate earnings, profitabilities. If we look at earnings revision, Japan earnings revision is actually the strongest among developed market economies. We think that there is more room for the micro news to boost further upside in Japanese equities, versus up until now, it has been very much driven by macro development in terms of what's happening in inflation, in terms of what's happening in terms of central bank policies. So now Japan is a bit of a consensus now, but just because it's very much liked by many investors doesn't mean that there isn't more room to go, and we continue to like Japanese equities.